Hey everyone, welcome to ESOP Radio. Our topic today is what happens after you've earned your ESOP wealth. What do you do with it? A lot of people out there listening to the show work for ESOP-owned companies and accumulate meaningful wealth over the duration of their career. We see that in our client base. We're excited to have special guest today, Peter Newman, who's a founder of Peak Wealth Planning. Peter, welcome to ESOP Radio, and give us a quick background on you, your firm, Peak Wealth Planning, and the work you do with both business owners and employees with ESOP account balances.
Thank you, Trevor. I'm delighted to be here today. I've spent the last 12 and a half years working with employee stock ownership plan participants on a number of very important topics. One is forecasting their retirement income, managing the diversification of their concentrated stock, as well as folks that have RSUs of public companies, equity comp, and managing that diversification and the financial planning and portfolios that go along with it so that people can transition into retirement. In addition, because many of these families, whether it's a company owner or ESOP participant, have built significant wealth, we do a lot of work on intergenerational tax planning and wealth transfer. And we've been doing this for over a dozen years. And we also work closely with clients' teams, attorneys and CPAs, or help them get those teams in place if they don't have it, to build proactive tax planning into the picture. Before I started Peak Wealth, I worked in higher education, the University of Illinois system, and I managed their endowments, which is basically a large pool of assets designed to pay income forever. And I bring that same fiduciary approach to the families we work with today. Before we dive in, I should just mention, thank you for having me on here. Because I'm a financial advisor, people always stop me at cocktail parties and ask me for advice. But I should explain, this is not individual financial advice. This is for education purposes only. And I'm delighted again to be a guest on the ESOP podcast. But folks should really seek professional advice from their own CPA or financial advisor.
Good disclaimer there, Peter. So you specialize in providing financial advice for what we're going to call successful people who earn their wealth at an employee-owned company. You've seen a lot of situations out there, obviously, and working for the university endowment, I mean, timing, right? The returns to the payouts and, and so on. Very similar here to what we deal with ESOP-owned companies. Employees work often for years at an employee-owned company, accrue meaningful wealth, sometimes in the millions. We see that. I was looking at one of our clients and their top ESOP balance is $15 million, right? So, I mean, that's wealth that needs to be deployed somewhere, once they take it out. So what is one piece of advice that you wish every ESOP participant heard 10 years ago?
I think a good thing to do is to take stock of what accounts you have, your 401k, your ESOP, and maybe do it yourself or get someone to help you forecast your retirement income. The inputs to that forecast are how much you're saving each year, what the investments are, what the rate of return. It's not a terribly difficult calculation, but doing some forecasting 10, 15 years before retirement, if you don't like what your forecast shows, for example, shows you cannot replace your income in retirement, you have time to adjust. Doing a forecast 2 years before retirement and finding out that you don't have enough to meet your goals, you might not have as much runway, as much ramp to adjust and make changes. And in addition to that, many folks have a partner or a spouse. So that forecast might also include not only what do I have, but what does my spouse have? So I think doing some forecasting, even if it's not super granular, but at a high level, is really important to do. The other piece is no one knows what's going to happen with taxes, but when you do those forecasts, you want to think about, well, my paycheck today is X, usually after tax when it shows up in my bank account, the company I worked for, but trying to forecast what's my after-tax income going to look like in retirement. Again, a little bit of art and science there, but at least thinking about taxes too early on might not hurt.
So planning for retirement early, that's sage advice, of course. The longer horizon you have, the more chances there are that, hey, you're going to meet your forecast or beat, right? That would be a great goal, is to say, hey, how do we beat, what we're planning here? At what age do you find that, because you talk with people of all ages, and all ESOP, account balances, and so on, right? At what age do you find, generally speaking, that people start paying attention to retirement and start zeroing in on what that calculation looks like, what their number is that they need to retire. Is it 20s, 30s, 40s, 50s, broad stroke, what age range, do you find, hey, there's an aha moment here that we need to start thinking about retirement?
That's an excellent question. And it definitely, that's saying your mileage may vary. However, what I generally see is folks in their mid 50s tend to start thinking about it like, hey, what's happening? How do things look? Oftentimes people have children, not always, but if they have kids, maybe the kids are in college or through college. And then the parents say, gee, what's the next chapter look like? We might want to start thinking about retirement. So that's one cohort I often see that may reach out to a company like ours or someone else for financial planning or do it themselves. The other cohort I often see are people that are, high achieving, hard workers, or people that just grew up in a household where finances was actually talked about. So I'll often also see people in usually their late 30s that are early starters or super savers that are like, hey, what's my future look like? I really want to plan for my future. It doesn't mean people in their 40s don't do this, but oftentimes the people that come to me hit one of those two categories. That's what I typically see. Once in a while, I'll talk to business owners in their mid 40s that have gotten their business up and going, and then the business is making money. And they may not be ESOPs, but they'll come to me and say, hey, got X, Y, and Z. What else do I need to think about? So that's typically what I see from a demographic perspective. But to your earlier comment, it's never too early to start, at least just have an awareness. Even if you just read a book or listen to a podcast about your future, your financial future, whether it's my stuff or your stuff or anyone else's.
So many ESOP participants view their ESOP account as their greatest financial asset. So of course that means concentration, right? If you have this ESOP balance that is 90% of your total wealth, okay, that's concentration, right? But it can be a good thing, right? If the value's growing and so on. But why is diversification so important from your perspective as a wealth advisor and fiduciary coming in and helping someone plan out their retirement goals, their future wealth?
I'm really happy you brought this up. I have a saying that concentration builds wealth and diversification protects wealth. But we're using this term diversification. I think we should explain what it means from the investment perspective and also from a layperson example. So diversification, at least in the way as investment professionals we think about it, it's typically selling a single company stock and then reinvesting the proceeds of that into multiple different assets. And that could be a stock fund that maybe buys the biggest 500 companies in the US. It might be a stock fund that buys every publicly traded company available in the globe. And both of those are readily available at a low cost. It might mean selling a single stock, buying a stock fund, and buying a bond fund, and also a real estate fund, depending on your goals. But diversification, we're moving from one single investment to multiple investments, hopefully through a vehicle that's simple to use and simple to access, like, for example, a market index fund. Well, what does that really mean in English, right? For folks that are non-investment folks, I like to vegetable garden. We have a huge vegetable garden at our house. A few years ago, I planted all the different crops, lettuce, tomatoes, cucumbers, peppers, squash, arugula, eggplant. And, each year some things do well in the garden, some things maybe not so much. But a few years ago, we had a bumper crop, like 75 butternut squash. They were gigantic, the size of like baseball bats, literally. So, and those keep all winter. So it's like October and we're giving them away to neighbors. We're using them for Halloween decorations. So fast forward in the next summer and we like squash. We're like, okay, well, we'll plant squash again along with all these other crops. Well, that second summer, the squash, some fungus or bug came and like wiped it out. I'm not sure what really happened, but because I had planted all those other vegetables, we still had enough to eat. So for like 4 months of the year, we didn't really have to buy vegetables at the grocery because we're crazy about vegetable gardening, like doing it. That's diversification, that I have a lot of crops I can still eat. So if you don't understand investments, think about vegetable gardening and a salad plate with lots of different vegetables.
So I guess the other analogy here, you gave the gardening, the farm example is eggs in one basket.
Yeah, don't put all your eggs in one basket, right? So that's diversification. And the reason it's important is you may have built $5 million or $7 million or $10 million or $1 million of wealth in your single stock account with your ESOP. But the question is how exposed, what proportion of that ESOP represents is that 50% of your total wealth? Is it 10% of your total wealth? Is it 20%? And every person's risk level of comfort is different, but maybe doing some forecasting and saying, hey, if I diversified and sold some of this stock, and we're going to the mechanics here, but if I sold some of it and put some of this money somewhere else, if for some reason something were to happen to my single stock, meaning the value went down, how affected would I be, and can I minimize some of that effect?
And to take a step back here, let's speak about diversification in the context of an ESOP. So for all you listeners who are new to the ESOP world, an ESOP is a retirement plan. So it's not a current taxable account. It's not a account that you can basically tap, like you can with your own stocks and bonds that are invested in, in your Fidelity app or whatever, right? It's a qualified retirement plan. So all the ESOPs do have diversification provisions in there. So generally speaking, you have to be in the ESOP 10 years and be at least 55. And then you can start diversifying out. So that's when speaking to someone like Peter makes a lot of sense at that point in time. Also, just wealth advisory, overall planning, that makes sense too, planning early. And then as you get closer to either leaving the company or retiring, then that's another trigger for being able to cash out of the ESOP and then do something with it, roll it over into another investment or take the cash and use it to pay down a mortgage, do something different, right? So when we say diversification in this case, it's literally that, taking your ESOP money when you're able to and deploying it somewhere else.
Yeah. And to add to what Trevor said, for folks that are new to ESOPs, because we may have some listeners that are, most ESOP participants receive a percentage of their salary every year of company stock in a tax-deferred account at no cost to the employee who is now an owner of the company. But they can't sell that stock usually until age 55. And as Trevor said, they have to have at least 10 years in the plan. Well, how much can they sell? Most ESOPs allow you to sell up to 25% of the shares you ever accumulated at age 55, and then an additional up to 50%, so an additional 25% when you turn 60. So at 60, you can sell up to half of the shares you've ever received. And then what most plans say is that when you declare retirement, most of them pay out 1/5 of your remaining balance a year over 5 years. There's some complicated math. It's not exactly 1/5, but for all intents and purposes, it's 1/5 of what's remaining over 5 years. Some ESOP companies are more flush with cash and want to get people out of the plan quicker. So they might pay out over 3 years. I've even seen 1 year, but the most common payout I see is 5 years. Be aware that plan documents can actually extend that payout longer than 5 years if you have very large balances. But 5 years is most common. One other thing on the payout is keep in mind that there might be a timing gap between when you file paperwork and when you receive a check. So
exactly. And yeah, they can often be, 30, 60 days, something like that, from the time you actually receive the check. So there's definitely timing considerations there. So Peter, you've said before, because you and I did a webinar here a couple weeks back, that was a lot of fun on diversification and strategies and giving those scenarios on different people at different points in their career, what they should do. So you said before that wealth creation and wealth preservation are two different challenges. Can you explain?
Absolutely. Wealth creation, at least for our ESOP participants, usually involves regular savings and investment over many years. And you build up these balances in your 401k, in your ESOP accounts, and that is usually hard work and concentrated activity. Once you've built up some substantial wealth, it's important to recognize that you want to preserve and protect that wealth. Well, why would I bring that up? I have a friend that hit a motorcyclist when she was younger and got her driver's license, and that family got in a lawsuit. Well, wealth can be lost in an instant by a lawsuit or a car accident, maybe through no fault of your own. In this case, the motorcyclist had pulled out in front of her and had a traffic violation, but it didn't prevent her family from being sued. So wealth preservation can involve multiple things. One is proper liability insurance. Another piece of wealth preservation, you're moving into retirement, for example, is do you have good tax planning? We all want to pay our fair share of taxes, but we don't want to write Uncle Sam or the state more money in a check than we absolutely need to. And then the other component, I believe, to wealth preservation is I've got a nest egg at retirement. Let's just pretend it's $4 million. There's a rule of thumb. It's called the 4% rule that says you can withdraw roughly 4% of your account balance and probably never run out of money. That's not guaranteed, but it's a rule of thumb. So if you have $4 million saved, you could probably draw $160,000 a year perpetually and probably leave $4 million to your kids if your portfolio is well invested. So if you have $4 million, you can draw out $1 million a year, you're probably going to run out of money. So there's some number in between 160,000 and $1 million a year. You might be able to push that a little bit, but you can't go crazy and take all your money out in 1 year because you won't have anything the following year. So wealth preservation has a lot more moving parts, I feel like, than wealth accumulation, especially for ESOP participants. Wealth accumulation can kind of be on autopilot. Wealth preservation and preserving an income stream forever sometimes involves a little bit more planning and some strategies and tactics.
Yeah, and that's one interesting distinction with an ESOP is that when you think wealth creation, right, at a very high level, very simple example, basically spend less than you make, right? That's wealth creation, and of course, ESOP comes in and it's basically forced savings because the company is giving you shares. They're restricted, meaning you can't just turn around and sell those shares on the open market and get cash. You have to wait till that trigger, which is often a long horizon. So ESOPs are generally speaking are wealth creators because of the long-term nature and also the forced savings nature of them. And you compare ESOP on company to, we're filming this on June 16th, so SpaceX just went public last Friday, and talk about the employees there, it's basically, hey, they got the stock grants, and accumulated huge amounts of wealth, right? And it was sort of forced savings, they were outside of the secondary markets and so on, they weren't able to sell their shares, right? And they're probably still subject to lockup periods and so on. But so you generally see that, for most employees who don't have, any sort of large inheritance, marital wealth, et cetera, family wealth, the way to create wealth is to get long-term equity at your employer.
Absolutely. Long-term equity is one that we typically see. And then outside of the ESOP world, the other wealth creation activity I see, folks, is just what I call super savers, people that save, especially starting in their 30s. They max out their 401k account savings. Maybe they even do some IRA accounts, and they're just disciplined about it and they do it regularly. You put I think you use the word autopilot or automatic, and automatic regular savings, whether in an ESOP or if you don't work in a company, maybe your spouse doesn't, in a 401k can really build that wealth. But again, starting early, right? If you're 25 and you save about $600 a month, you can have $1 million at 65. If you wait till you're 35, it's about $900 a month. If you wait till you're 45, it's almost $2,000 a month. And if you wait till you're 55, it's about $5,500 a month that you need to save to hit $1 million at 65. So starting early is really important.
Time value of money, compounding
return. Absolutely. So it's very important. Maybe we should, because we're talking about compounding, it's important for folks to recognize most ESOPs are really well-run companies and they're all rowing the same direction. The management, the employees and incentives are aligned and have good returns. There are occasional outliers. Not every company is perfect. And it's important to remember that you're working at an employee-owned company where you're building wealth as well with these stock grants. So let's pick on an example from 2001 and another one from 2002. In 2001, there was a company called Enron that was an energy company. And that company, it wasn't necessarily employee-owned, but a lot of those folks had Enron stock in their 401k accounts. It was very common for Enron people to have a lot of stock in their 401k. That company got in trouble with some off-balance.
What was that book? The smartest people in the room. If you ever want to get a book to read on a plane or whatever, look that one up. It talks about the inside workings of, how Enron did what they did.
Yeah. And there's 20,000 people lost their jobs and their retirement savings all in one fell swoop. And other examples that are notable are Eastman Kodak. Eastman Kodak actually had a retirement stock plan. WorldCom also. WorldCom at one point handled half of all internet traffic merged with MCI and then went bust in 2002. So it doesn't mean that every company is perfect. Again, most are
Yeah.
really well run. There are occasionally these outlier events that do occur. And that's why we talk about diversification and wealth preservation.
Exactly. And all companies, whether it's the most well-run ESOP company, whether it's Fortune 500, et cetera, they all have the same forces: market forces, technological changes, competition, classic SWOT analysis: strength, weaknesses, opportunities, threats, right? So if you find yourself having a sizable ESOP balance, make sure that you're cognizant of that. Hey, be very objective in that position, right? And be objective when you have the opportunity to diversify. So let's talk a bit about mistakes participants might make. So Peter, you've seen a lot of scenarios out there, of course, through your many years doing this. What mistakes do you see ESOP participants make when evaluating their diversification opportunities? Because the opportunities come up, really, you get a notification on the website, or you get something in the mail that says, hey, you want to diversify? Check this box, yes or no, and return it. And that's what happens. So it's, what mistakes do you see when people are evaluating that? Because it's a huge decision, right? And you can kick the can down the road, maybe no decision, right? That's always something, no decision. But
A no decision is a decision.
That is true. No is, yeah.
So I think one mistake I see just in general is not thinking about your retirement timeline, not doing an income forecast, and not recognizing the concentration you have, right? Just ignoring all these factors. If we flip this on its head and say, should I diversify? If I do a retirement income forecast with my retirement timeline, especially at 55, and it shows I can meet my income goal, and in particular, if I can meet my income goal, if I take a little risk off the table, sell that single company stock. If my ESOP is more than half my nest egg, I should probably consider diversifying, right? Just in case there's some event that's beyond the control of the company that could hurt my single stock. Single stocks often move around more in value than broader invested portfolios. But more specific mistakes I'll see folks, now maybe it's not a mistake, but it's a decision to pay more to the IRS. I have seen occasionally folks say, I'm 56 and for whatever reason I need cash today, and I'll take my diversification check of $250,000 or $500,000. I'll take my $500,000 diversification check, and rather than move it to my tax deferred IRA, which I'm usually allowed to do, I'm going to cash that check in my bank account. Well, all of a sudden this year, I'm paying Uncle Sam a 10% tax penalty, $50,000, because I cashed my check before 59.5 out of my tax deferred ESOP account. And I've just pushed up my regular income from, say, $150,000 that year to $650,000, $150 plus the $500,000 payout. So not only did I pay a tax penalty, I'm all of a sudden in probably the highest tax bracket at $650,000 of income. One of the things people can do to avoid that mistake is think about, do I really need that cash today, or can I get that money from somewhere else, either through planned savings or home equity? And can I spread out that tax bill over many years by moving my diversification to an IRA?
So that 10%, that 10% hit is, that's real. And in this example, they just waited a few years, rolled it over to an IRA, then started taking the money after they hit 59.5,
Exactly.
and they have a couple more years of return, as well in the market, and so on. We do see that, across our client base. One thing we do here at Menke, we help business owners go through the whole ESOP, raise the capital, execute the transaction, and we do the ongoing administration. So we have a large, what's called a third-party administration team. And we have tremendous data on that side. We have nationwide clients. We have right now 600, and counting, all sizes. Average is about 150 employees. So we have tremendous data throughout our 52 years in business. And you do see human nature come in a bit here. So some people, when they see they can get cash, they're like, yes, I'll take it, no matter what the consequences, as you just pointed out. Others, it's a much more calculated approach, right? So education, though, in our opinion, will educate people. Hey, you do this, yeah, you're going to pay this 10% penalty and put yourself in probably a much higher tax bracket, as you pointed out. So it's going to be a bad tax answer, probably a bad retirement answer too. So unless you really need this cash, consider
Absolutely.
a smarter alternative.
And you raise a good point. Taking the cash today and not rolling it over to an IRA or 401k, when you're eligible to diversify at 55 or 60, if you needed that money for your retirement income stream down the road, which usually involves I've got a lot of money in a 401k or an IRA, and I'm just going to take regular withdrawals. Now, maybe I've got 2 million and I'm going to draw out $80,000 a year from my accounts and keep those accounts invested. Well, I need that $80,000. If I retire at 65, I might need money for the next 30 years till I'm 95. And who knows what's going to happen to Social Security. Right now, I don't see Congress having the will to fix Social Security, and that may or may not be fully present. We could see a haircut on Social Security in 6 years.
Is there going to be Social Security for us? It's like,
I'm not really sure. The other mistake I do see, and I did want to mention, is sometimes see people, we mentioned this, ignoring the decision. And, I have a client I worked with, when I started working with him, I still work with him, but I started with him about 12 years ago when we opened the firm. And his ESOP balance in the 5 years before I met him went from about $1.1 million down to about $400,000 up to over $4 million in a 5-year period. So imagine if he was turning 67 when that account balance dropped from 1.1 million to $400,000, he would have had to delay retirement. And that's for folks, especially if you run into a health concern, which sometimes forces people into retirement, or maybe you don't, but your spouse or partner runs into a health concern, or maybe you have to move across the country to take care of an aging parent and you can't do your job anymore because it's not a remote job.
Well, just real quick here. Okay, so the account balance was 1.1 and then it dropped significantly. Do you remember the what was going on at that company?
That was the name of the company. They had done a large acquisition and taken on a lot of debt, so it temporarily depressed the stock price. And then they integrated the acquisition. They brought back another CEO. They really did a great job growing the company. So it was temporary, right? So it wasn't no one did anything wrong. The acquisition turned out to be additive to the portfolio of companies that company owned, but that really caused the stock price to fluctuate. And there was actually a shareholder lawsuit over it. So
interesting. Okay. So they basically took out debt, did some acquisitions, and it took a while for those synergies to take place, for that to be reflected in the cash flow. And this is one key thing, to talk about ESOP valuation. It's much different than the public markets, where there's a market, where you buy and sell, every second, the NASDAQ, Dow Jones, et cetera. ESOPs are valued generally once a year, and they all tie back to the cash flows. The cash flows of the company supports the value, supports your ESOP account balance, and basically supports getting paid out. So anytime there's an impact to cash flows, whether it's positive, negative, or neutral, you're going to likely see that reflected in the value that shows up on the account statement. So ESOP valuations go lock and step with cash flows, and this example here proves that.
Absolutely. And to add on to what Trevor says, just said, today's interest rate environment, interest rates look like they're creeping up. There's some inflation, whether, we can argue about tariffs all day long, but there has been some inflation. So we may see potentially more muted stock price increases with higher inflation or higher interest rates. And also the valuation cycle Trevor mentioned, most, I'm sure not all, of the ESOPs I'm familiar with, they typically will value their stock sometime in the spring. And that share price gets told or revealed to the ESOP plan participants, usually around June or July. And then folks get a letter in the summer that says, you're eligible to sell back some shares. Do you want to sell back shares? And if you do you want to check in to put in your bank account? Do you want to roll it to an IRA? And by the way, what IRA do you want to put it in? Or do you want to put it in your 401k? So many times we get phone calls and people say, A, should I do this? B, I don't know how to create retirement income. So we'll say, we'll help you move it to an IRA, and then we'll help you create the retirement income when you stop working. But that window, that timing, that generally opens once a year. So if you don't do it this year, it's not the end of the world. You can do it next year, but you've made a conscious choice to wait a whole 12 months. Like Trevor said before, you can't just call up a broker and sell it in the open market today. Similarly, at retirement age, because of that time cycle, depending on the plan year and when you declare your retirement eligibility, if you declare retirement on January 1st of a new plan year for an ESOP company, it could be 16 months before you get your first distribution, that 1/5 of the year we talked about before. So it's really important if you're thinking about retiring from an ESOP to understand the calendar of when distributions get paid out and understand when you declare retirement, when does that start the clock and when do you actually get a check? So there's a lot of moving parts here. One of the things we try to tell folks to do is, hey, have a few years in cash anyway, just for good, prudent investing, whether that's in a Roth IRA or a savings account. So your first couple of years of retirement, you might not be pulling money right out of the stock market. And if you've got a gap in your ESOP distribution, you can cover your expenses.
Yeah, the timing is so important. 'Cause a lot of people, they look at the statement and, in their head, like, yeah, this is what I have. I can tap at any time. But Peter, as you pointed out, there's a big timing consideration here. And you don't want to be caught surprised when you do retire and that there is that delay. No, you need to actually have a plan and model out that cash inflow, in that right period that it's coming in.
Exactly. And for most folks who've done some diversification, then they may have some money in an IRA that they can access at any time, especially if they're older than age 59 and a half, they don't have that tax penalty. They might pay regular income tax pulling it out of an IRA, but that money is accessible to them in the IRA. The other thing that is really interesting to me, having done this for a long time, is the mechanics of withdrawing money to cover retirement expenses. A lot of folks are not comfortable doing that on their own. It could be a little scary to have $3 million in one account and knowing what to sell from that account to fund your living expenses and how to do that every month. And the other added component is when you work at a company, they take money out of your paycheck and pay taxes to the federal and the state that you live in. When you retire, you have to do that on your own with the help of an accountant or advisor. We actually work with clients to forecast how much they're going to pull out, and we send the money to the feds and the state for them so they don't have to worry about it. They still have to be accountable at the end of the year, and we work with them and their CPA to true it up and say, do you owe money on your taxes just like you do when you're working? But we try to level set that during the year so they're not surprised come April.
Yeah, so Peter, given today's economic environment, are there particular diversification strategies or asset allocations that participants should be thinking about? I know it's a very dynamic environment. We had the tariffs, last year. Those are still going on at different percentages. Let's see. Obviously, Iran, gas, fuel costs, inflation, is 4.2% now. Of course, they're saying the Strait of Hormuz will open any day now. That might go, inflation related to fuel costs maybe will go down. But it's a very dynamic environment, right? And also one that is proving difficult to make any sort of long-term planning moves in, based on macro conditions. So, given that, has that modified your advice? And, are there particular strategies, that you're deploying these days?
That's a really good question, Trevor. I've been a professional investor for institutions and managing people's retirement assets, but it's a combination of those for 26 years. The way I view that is you really want to think about your investments in 3 buckets. Cash is for money I'm going to need 1 to 3 years from now. Maybe some income producing assets that might be a real estate fund that pays some dividends. It might be a stock fund that pays some dividends, or it might be some bonds that pay regular interest income. And I probably want to align more conservative bonds and less risky dividend paying stocks for money I'm going to need the 4 years following those first 3 years. And then everything else I'll put in the bucket. If I mentally bucket years 7 or 8 and beyond, I'm going to put in growth. And for me, growth really is owning public market stocks of both international and US companies that are in low cost funds. And the growth, you mentioned inflation, right? Everyone's concerned about inflation. 10 years ago, I could buy a cup of coffee at Starbucks for $2.50. Today, it's like $5. So if I want to overcome that, so when my cup of coffee in 12 years from now costs $9, I'll probably just make it a home because I'm frugal. But if I do go out to Starbucks and I got to buy Trevor a
Well,
coffee,
buy an espresso machine.
Exactly. But if I do go out to Starbucks with Trevor and I'm going to buy him a coffee, I probably want to have invested money that I'm going to buy that coffee with 12 years from now in the stock market. It's not guaranteed to always go up, but history has shown that stocks generally outpace inflation and have growth over and above inflation. The last 10 years of US stock returns have probably been over 10%. International stocks haven't done quite as well the last 10 years. But there's a lot of valuation data and a lot of published research that says international stocks may outperform the US in the next 10 years. That may or may not be correct, but we've shifted our portfolios a little bit more towards international in the stock allocation for those longer term growth needs. So that was a long way of saying have conservative investments for bills you're going to pay right away and have more growth oriented stock investments for bills you're going to pay 10 or so years from now. And the reason why is if you own stocks, if I have $3 million in stocks, if this war in Iran spirals out of control and oil prices double, that our stock valuation, my $3 million portfolio could drop to $2 million. So I don't want to be freaking out and selling my stocks when they just drop by 33%. I want to take my money from my savings account and pay my bill and wait for that market to recover. And that's sometimes hard to do. That's why thinking about these things in advance and having a plan or getting some professional help is often better than having no plan.
Absolutely. Yeah. Having a plan is definitely sage advice here. So Peter, if someone listening today only remembers 3 things from our conversation, what would you want those 3 things to be?
The 3 things would be forecast your retirement income. The second, which we didn't really touch on too much today, but consider how your expenses might change in retirement. You're going to have to pay health insurance for a few years before Medicare, for example. Is your mortgage paid off, right? That lowers one expense. The health insurance might be higher. And then protect your assets with proper insurance, right? Have some liability insurance, do an insurance review. Maybe you don't need life insurance when you retire, so you substitute one insurance for the other. And my bonus thing is spend time with the people you love and the people you care about, because all this money talk is really great, but if you don't get to do the things you enjoy and spend time with the family you love, it may not be all worth it. So I would really spend time with people you enjoy.
Awesome discussion. And I love these 4 things: forecasting income, forecasting retirement expenses. Your example earlier today about the accident with the motorcycle, and so on. Umbrella policies are cheap. Make sure you're covered according to your asset base there. Manage that risk. So great stuff. And of course, spend time with loved ones. That's highly underrated.
Yes. And in our busy society, we overlook that sometimes.
Absolutely. Yeah. So otherwise, what's the point of it all, right? So Peter, if listeners want to learn more about you and Peak Wealth Planning or connect with you directly, how do they do so?
Sure. Feel free to go to our website, peakwealthplanning.com, PEAK wealthplanning.com. You can find me on LinkedIn, Peter Newman. And if you go on YouTube and search for Peak Wealth Planning, you can find our YouTube channel. And I believe they'll also be in the show notes today. And Trevor, I'm really grateful for you having me on. And this is a lot of fun. I always enjoy our conversations.
Likewise, this is one of my favorite ones is retirement planning, wealth planning, and forecasting that out. It's meaningful and it's so important. And thanks again, Peter. Thanks everyone for joining us today. Check out more episodes of ESOP Radio. Also, check out our ESOP Bootcamp. That's up there. Covers we have 10 episodes, cover everything from beginning to end, basically what an ESOP is in small bite-sized segments. Our ESOP Radio channel can be found on your favorite podcast app. So that's Apple, Spotify, YouTube, or on our site, Menke.com. Again, I'm Trevor Gilmore, CEO of Menke. Feel free to reach out to me. I post on LinkedIn. Name is Trevor Gilmore. You can connect with me there or shoot me an email. Thanks, everyone. Have an awesome day.